Hey guys, welcome to this week's edition of The Squawk. I'm Pav, lead market analyst here at Swyftx, and we've got a pretty interesting episode today. We're going to jump back into the macro after following the crypto market these last couple of weeks. We've actually had some pretty big changes, particularly in the US, which I know we speak about the US quite a bit, but trust me, there's no favoritism there. Just so everyone's clear, they are the largest GDP producer in the world, that's gross domestic product, largest consumer base in the world. So when we're talking risk markets like crypto and Bitcoin, and even broader than that, is where a lot of the consumers really come from. And also it does have a knock on overall consumer habits globally as well. There is that spill out effect. So that's why we spend so much time focusing on what's happening there from an economic policy point, particularly as we have seen since 2022 a regime come in, which is more about tightening up the fiscal balance sheets, getting rid of some of that sticky inflation. You could argue we haven't seen great success here in Aussie shores with the recent rates at the RBA going up in the last two meetings, but there's a really interesting theme that I'm really excited to cover today, so we'll just dive right in. But first, we'll cover a little bit of the markets. We have seen a bit of a flattening in terms of returns, so we'll see how the market holds up into the weekend and next week. The major callouts, we are still continuing to see Hyperliquid and ETH, which have been top performers in the last 30 days, continue to show their strength at least. So we've got that going as well. Now the big thing that happened this week was the FOMC, which is the Federal Open Markets Committee. It's a very fancy name for a group of people that essentially go out there, try and understand how are jobs and inflation working together or against each other to set forward guidance or monetary policy on how the US economy is going to approach the coming quarters, the coming years. So good example, when we did see too much inflation in the economy in 2022, the US Fed started hiking rates, just a way to stop people borrowing money, spending money, etc., remove a lot of that frivolous cash spending in the system. And also in 2024, we saw the opposite. We saw them start to loosen the strings, start to reduce that interest rate, headline rate. But what's important to know this week is that we have seen the interest rates remain put, but there have been some key changes into what the committee is expecting for the rest of 2026. And I want to spend time explaining this, just so everyone's aware of what's happening there. When I mentioned that the committee, they have a dual mandate. That's a very fancy way of saying they have basically two things that they're trying to keep in check, both employment and growth, as well as inflation. So one hand kind of feeds the other. We do see some cyclicality when inflation increases. Usually those are periods of growth like we did see in 2020 and 2021. But what we have seen most recently is a higher than expected rise in the unemployment rate. So really the key thing that there is concern of, and it was mentioned in this meeting as well, in a statement by Jerome Powell, he has commented that job gains, they've remained low. There is some sort of awareness and concern, even in looking back at meetings from November and December, where they did mention that they were very closely watching employment more so than inflation. And what we are starting to see is if we look at this chart here, which just shows the unemployment rate over the last 3 years, it's pretty quick and easy to see which way this is going. It's going up, right? So the concern is if this does keep materially spilling over to the upside, it's going to likely require some sort of policy intervention. So they could look like interest cuts, it could look like stimulus packages. We don't know. We're not calling for a 2020, 2021 COVID-style recovery in terms of what they do for the market to stimulate it. Right now at this stage, that was a once in a lifetime thing until proven otherwise. But also interesting, we look at a metric like inflation over the same period of time. We have seen in the US, again, this is specifically, it was as high as 6% in February 2023. And we are getting close to the Fed's target, which is 2%, currently sitting at 2.4%. Now, I did mention that something has changed. And if you look into a lot of these meetings, once a quarter, they do release a PDF version of what is the committee, so the group of people's actual expectations on how these metrics that are measuring jobs, growth, inflation, etc., how do they expect them to move heading into the back end of this year, as well as into the future. This is what we call like forward guidance that they're providing on how they're going to run the economy. So we just zoom in here. I won't dive into any other part of the report. I've got the links in the article for you to check out. The key thing here is I'll go line by line. We've got the growth, so the real change in GDP or gross domestic product. How much is a country making? They currently have a expectation that is going to increase. Now, as I mentioned, usually for GDP to increase, you need people to start spending money. The current GDP is influenced approximately 68 to 70% by consumer spending. If you think about consumer sentiment, as we spoke about 3 editions ago, which you can check out at Swyftx Learn or on my YouTube, we spoke about how that is at 2022 lows. Like, it hasn't been this tough for the consumer since that we could call the previous bear market. So it's really interesting to see that they're expecting that growth to accelerate. The unemployment rate, they're expecting to stay steady, which we already saw it blow out higher than what was expected by 0.1%. And they're expecting inflation, which is these 2 metrics here. One is removing input costs like energy and food, which is the core PCE. They're expecting that to potentially run higher. So this is really interesting, because the rhetoric from the Fed all this time has been that we need to get inflation towards a 2% target. It seems like their focus right now is solely more so on unemployment and keeping that in check, rather than having to worry about moving towards a more aggressive target when it comes to inflation. So it's yet to be seen, but you could make the inference that maybe the Fed does believe they've got inflation under control as best as they can for where we are right now. So it doesn't map it, that you can't see as we project down to the future. They still anticipate by 2028 we're getting to that 2% target. So they may just be willing to potentially come to the rescue a little bit, be okay with a little bit of inflation if we do see that 4.4% unemployment target be at risk. So a blowout of that is obviously very bad. But again, we can see that unemployment, they do anticipate that they're going to be supportive and look to increase that over time, whereas growth, they do anticipate to cool as we head out of 2026 too. That's what we're looking to do here. We're just trying to understand how are policymakers viewing what's happening currently in the market. We have quite a bit of tensions over in the Middle East. We have an input cost issue with the oil and energy crisis right now that's happening globally. And now it's impacting more than just oil. We saw LNG also impacted as well. So it really does set a very interesting end to the first quarter. What's going to be happening in the markets over the next couple of weeks, couple of months. It's really going to all fold back into this schematic. And it's really going to be what the policymakers are going to be looking to interpret as to what to do next. Really interesting. But with that all said, obviously impacts to crypto, we wait to see what that will be. Obviously, if we do see a spike in unemployment rates like we have most recently, it hasn't been welcomed news for the market. We have seen a bit of a sell-off, as well as most recent inflation metrics. There's been a few anomalies where we have seen actually spikes. So obviously the market's very sensitive to that. We did see a drop-off as well. So while this could be looking potentially better in the long run, in the short run, you could argue this actually spells more pain for the crypto markets as well. So it's a bit of a 50-50 double-edged sword. But we'll be back again next week to fill you in on what we're seeing. But for now, we'll catch you again next time. Thanks, guys.